Ladies and gentlemen, welcome to another War Room number 73. It's been almost a month since I did one of these. And I've explained on social media, I've explained in the public Telegram group as to why, but I'm happy to be back. Shake my hand one more time, just shake my hand. Good to see you. If you're old and you're an old subscriber, good to have you back. For a new subscriber, don't forget to hit the subscribe button. Don't forget to like the video. Let's get into it. I've got a lot of things I want to talk about today. We kind of have to catch up with what's been going on in the markets first. Okay, so that's number one. Then we also kind of have to then use that information to make a very good market speculative prediction, right, so to speak, of what's going to happen this Wednesday when the FOMC sit down to vote for a new Fed fund rate. I can tell you the market speculation. I can tell you what I've seen in the markets. We're going to kind of like discuss these things as quickly as possible. And then we need to look at about, give or take, 17 assets, right, in the currency markets where I think you should be buying and selling. And that's the whole purpose of these forums, by the way. I map out swing trade ideas that in the long haul, sometimes, generally speaking, most of the time, have a high probability win rate setup. I am, of course, a supply and demand trader. I use smart money concepts to confirm my supply and demand entries. I truly believe that if you want to advance in trading Forex, stocks, crypto, indices, synthetic indexes, which is everything that we cover on this channel, you are going to need to understand how institutions play in the game. Don't forget to check out the links down below. Let's start, right? So, good to be back and really good to see everyone, and I hope everyone has been well. This week I'll be more active now in our public Telegram group, moving very forward. I just want to make sure you guys can see my screen on screen 2, right? What's going on? You see, I haven't done this in such a long time. I apologize. So screen 2, let me just quickly share the whiteboard with you. Right, there we go. Right, so we've got a lot of things to talk about, right? And we need to catch up on all these things. We need to quickly synthesize the data that came out on the 14th of July. I mean, there's other data earlier on, like NFP and all these kind of things that I'm pretty sure if you've been following this channel, you kind of understand the buildup, right? You know the job of the Fed is to take care of prices and job numbers. And in the job number front, there seems to be a lot going on there that's going in the right direction, right? But I think the main thing that brings us together actually starts somewhere here. Inflation is said to have finally peaked, right? So that's kind of like a debate. That's another here, no there, right? But historically speaking, let's put it that way. Historically speaking, when inflation gets to about 9% in the United States, they normally believe there's a peak. And this is like based on a wide span of historic data, right? How high can it go, right? Is it going to be a whole Zimbabwe situation of hyperinflation? Probably not. The Fed, Powell, the FOMC will throw as many tools as they can into the market space to make sure that does not happen. The main tool they're using is the Fed fund rate, also known as the interest rate, right? Which is what we've been tracking on the channel since the beginning of the year, which reminds me, this Wednesday, I will go live to break down, all right, what the FOMC is saying. But be careful, I do not think it's going to be 8 p.m. South African time, right? I think it's going to be much earlier during the day. If you look at Forex Factory, it looks like the press conference and the rate will come out at about 2 p.m. and the press conference at 2:30 p.m. this coming Wednesday. So I'll stream that event for you live. I will be breaking down what's been said, the special economic projections, the GDP numbers, all those things I'll mesh it out. But the recent inflation data that we got from CPI on the 13th of July, if I'm not mistaken, and the PPP data, right, all kind of like, ensued that, inflation was gunning for, I think the number what they were looking for was 8.8%, but instead they got 9.1%, right, which is, right, more inflation, right? But markets also took, to consideration that maybe the peak has happened. Now, who's been talking about the peak? Powell has been talking about the peak, the governor, for a very long time. His original, first meeting in March was, well, let's see the data. Let's look at the CPI numbers that come out from August and September. And I kept relaying this information on the channel, right? So we finally have a July number, which is 9.1%. What is going to matter the most right now for the market is August, September. We want to see the next inflation readings drop from 9.1%. This is the only big sign there are many other signs. This is the major sign that finally inflation has indeed peaked. Another way to interpret this would be finally the Fed moving from 0.25 basis point and then jumping to 0.50 basis point and then jumping to 0.75 basis point is finally working, right? So that's the only way, or one of the main ways the markets are going to be interpreting that data. So look out for CPI numbers in August and September. These ones really matter. They really matter because we now have a peak, a very high inflation reading, and what we want to see is price coming down. If we don't get that, and the next inflation reading is actually bigger, right, then you can imagine all hell is going to break loose. Now, since the 13th of July, folks, since the 13th of July up until about, I guess now, there's been a lot of conflict, in terms of the information that's been aired out. Different members of the FOMC came out, to give different readings, different recordings, different sentiments about what they felt, right? And I really want to break this number down as quickly as possible to you guys, and then we can then kind of like venture into what I think that means for the market. Whenever these data points come out, the Fed just gets all excited, panicky. There's always a sense of chaos. And remember, the number one thing that the markets hate the most is a feeling of uncertainty, right? When you're working with data clusters that don't make sense, when your financial analysts can't get the right numbers right, when the Fed is not united front, all that spells out for the market is market uncertainty. Market uncertainty breeds market fear. Market fear fuels the bears, right? And you just get a downside there. Now, so, during my time off, and I think the festival was over at that particular time. So it's kind of like going through articles just in bed, kind of like sick, but then trying to just, consume a little bit, an hour a day, just to stay on touch. I noticed something quite peculiar. I just want to put it up here on the whiteboard. I've got a quick summary of exactly what was happening, and I'm going to break it down, bit by bit. So the very first thing that happened was different members of the FOMC came out and they all just started saying different things. Literally, every single person had their, 5 minutes of fame, about the market. And that has a tendency to confuse the market. All right, that's the main first thing. There is a tendency to confuse, because remember, the FOMC is made of both very hawkish members who want the interest rate to go up as quickly as possible. So basically, to deal with the problem head on, right? Why do a 25 basis point or a 50 basis point when you can just do 100 basis point consecutively, right? 3 or 4 times, deal with inflation. Within that same group, you have dovish members, right, within, the FOMC, who actually believe, well, don't do that because you might rug pull the market. Don't do that. You're going to kill the stock market. You're going to kill demand, and you might actually break, I guess, investor psychology, right? If there's nowhere else to put money, if you make the markets completely illiquid, crypto dropping, housing market dropping, stock market dropping, where will investors put the money, right? You're going to get a crazy panic, and you're going to trigger a 2008. Now, the FOMC is made of these two main voices, and in the middle is Powell, right? Who is to kind of like, take all this information in, and through a voting system, make what they believe to be the best decision. Now, I've got a new video coming out maybe 48 hours from now. I want you to see the history of FOMCs before Powell's group and how wrong they were about the 2007. I'm talking about, complete indictments, real life, quotations, their analysis completely of leading to the great financial market crash in 2007, 2008. For in the public Telegram group, please join my public Telegram group. It's completely for free. I put the link is down below. I put to you guys, please watch The Big Short, and Margin Call, those two main movies, because I really want a visual imprint in your minds. Those two movies were based on real life events. They're actual bigger documentaries I can even recommend, just to see how wrong our experts can be, how wrong the people we trust leading our economies can be, and why it is very important that every single individual under the sound of my voice of the planet, blah, 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 takes this seriously. You take your own financial, your investment, your trading portfolio, your pension funds, your mutual funds, your unit trust funds, your savings. You take all these things seriously. You become the captain of your own ship, right? So CPI comes in at 9.1. It's very hot, and all of a sudden we have the Fed, coming. So the first guy who comes in is Bola, and his basic argument was, he thought, well, let's get the interest rate at a neutral level. Now, here's the thing about this so-called neutral level. There isn't even consensus of what a neutral interest rate is. We know, according to Powell, it's between 2.5% to about 2.50%, right? That's what they call neutral, right? So is it 2.25? Is it 2.50? You might be thinking, but Leroy, is there really much of a big difference? There is, because there is a 0.25 basis point in between, which could be a rate hike, right? Essentially, the first rate hike of the year was 0.25. So it's actually quite a big deal that the markets, you and I, actually know what is that neutral point. What is that sweet spot that the FOMC believes is the right place to be to tackle inflation? But Waller said, look, Ben, let's get us to the neutral place first. When the CPI numbers came out and they were looking a little bit crazy, and PPI numbers came out on the 14th of July and they're looking a bit crazy, he was the first member of the FOMC to say, let's gun for neutral first. Let's get a neutral rate going, and we get a neutral rate going, then we can look at the damage. We can then start to wonder, well, is this good or bad? Where are we? Don't zone out. By the way, I'm going to give you signals. Signals are coming, but you have to understand the context. This is the business, right? Trading is a business. If you're a baker, your main concern is not just selling bread. You need to understand the wholesalers, how much flour is in the country, cooking oil, all your ingredients, the transportation to the consumer. This is what I'm doing right now. I'm breaking down the fundamental stuff that is going to impact the sentiment that we're going to be trading in from tomorrow, because Wednesday is around the corner. Markets price in everything, and what that means is markets today are a reflection of a future inclination, a future destination. If you don't understand that right now, you have no business opening a buy or sell trade. So please don't zone out, right? YouTube will tell me where your retention and your concentration drop off. And I know it's because I'm not talking about pound USD, buy here, sell here. But what's the point? What happens if one of my kids is sick and I can't do videos this week, or I get busy and I have to catch up with my floor traders, which is really what I need to do this week, right? So it's important that you gain understanding of what's going on, right? So there's this neutral level that Waller says we should get to, all right? And like I say, there's a little bit of a debate as to, well, what is this neutral level and where does it stand, right? So Laura Bostic came out saying, well, no, everything is on the table. So a different member of the FOMC, right, this lady here, came out and said, nah, actually, dude, every single thing is on the table, right? So Waller says if we add a 75 basis point this Wednesday, all right, 75 basis point this Wednesday, it would take us to that neutral number, roughly, right? Remember, right now, I believe the current rate is at about 1.5%, whatever, and then if you're to add, 0.75, you're very close to that neutral number. But the second member of the FOMC, Laura, was like, nope. Actually, everything is on the table. So this was like panicking when they saw the data, like including 100 basis point. We could see 100 basis point on the table, meaning instead of this 1.50, which is what we have right now, plus a 75 basis point hike on Wednesday, she's like, no, we won't do a 75 basis point. There is a likelihood that we could do 100 basis point, which would then lead, put us at about 2.50, which is once again, both of them would get what they want, depending on what that neutral number is, because he would get his 2.25 here, while Lara would get a 2.50, right? And this is tricky. We're in tricky territory because the Fed wants to do the right thing according to their mandate and policy. And you know how I feel about them, right? I've told you guys many times, they've been behind the ball. They are literally leading the crisis, right? Like making it worse and worse and worse, right? But they've got many things to juggle. And one of them is, well, Powell then came out and said, look, man, if we give you guys, 100 basis point, this might cause super high unemployment. And if you've been tracking the NFP numbers, right, unemployment has been, it's unemployment. The unemployment is around about 3.6 in America right now. And that's the sweet number, 3.5, 3.6. They have been constantly, the economy has constantly been creating jobs, right? And I know for a fact Powell doesn't want to mess that up. Now, let's quickly explain this. The higher the interest rate, right, the quicker you are at a place to kill demand. I've spoken about this many times. You've heard Powell say many times in the life, we gotta kill demand. We gotta drop stocks. We gotta kill the house market. We gotta kill, this massive barrier that wealthy people have over the economy, because it's wealthy people who spend the most. So if you attack, the assets that produce, money for them, you might scare them down at reducing in spending. When you reduce spending, you reduce inflation. That's the whole formula, right? That's the whole point of this whole thing. But it says, if we go too hard, we do 100 basis point, and we rate hike too fast, what's going to happen is these companies are going to get so shell-shocked. The stock market represents companies, don't forget that, right? That they will start to purge people. And we've seen this a lot. I mean, I'm pretty sure you guys have started to notice a trend. First it was in crypto. Coinbase is firing 1,000 people. Celsius Network firing 1,000 people. All of a sudden, there's been a lot of tightening of jobs in the economy. I mean, I'm not just talking about America, but I'm pretty sure wherever you are, in whichever country, globally speaking, people are losing jobs left, right, and center. And the reason for that is, or not even the reason, but this is an end result of what it looks like when you start to do what's called monetary policy tightening. The tighter your interest rate is, the more shock these companies take. They quickly start to dump people, right? So we're seeing everywhere crypto layoffs. Google was freezing intakes. Tesla, massive layoffs. Facebook, Meta has been warning, of massive layoffs to come. Why? There's a cooling of demand in the market. Remember, if I fire you, if you work for me and I fire you, you lose your source of income. What does that mean? Well, if you don't have a source of income, you stop spending. Now, multiply me by 1 million bosses across the world. If we all start to lay off people, stop employing people, we start to cool down in the economy, right? It's an old classic Keynesian model of handling macroeconomics, right? Where the state gets involved in different ways to actually help the economy when it's overheating, cool down, when it's too cold, start to heat up, like we saw in 2020. Hope you guys are still with me. And if you're still with me, I'm just rushing so I can get to the signals, but I want you to understand the stuff. Feel free to like, don't be shy. Hit that like, let me know. But it's very good to be back. Now, when there's a cooling of demand, right, you get scared to lose your job, blah, 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 like I've said here, then all of a sudden you stop spending, and there's a hope, a likelihood that we might start to see inflation coming down. And so throughout the month of June, July, a little bit just before that, but I've been seeing these headlines become so popular in the whole month of June and July, layoffs after layoffs after layoffs after layoffs. And that's part of the reason why the Fed is scared that if they jilt, the interest rate, way too hard, way too harsh, these numbers will explode of the number of people being unemployed. And all of a sudden, the Fed will have two problems: fighting inflation, pricing, but also a growing number of unemployments. Very complicated dance, that they kind of like find themselves in. Right. So with all this being said, I think we can then start to really create the big debate. The big debate is always going to be, are we in a bear market or in a bull market? It's that simple for a lot of people. Bear versus bulls. Where are we? Because that has to determine a climate, and that climate then determines a trading strategy or an investor's long-term perspective. But without the understanding of that, what are we doing this week? And specifically, what is going to happen to the markets from Wednesday? And that's what I want us to kind of like conclude, this little summary with that. Another thing that I did pick up, when I was away, was the fact that I truly believe, and I say this, guys, watch my videos from 6 weeks to almost 2 months ago, right? I kept telling you guys that euro is by a demand, but euro is weak. Don't buy euro. I say this many times. Then the first demand broke. Then went to the second demand. I said, look, man, trust me, it's still weak. Do not buy the euro. Now, right now, on the right side of your screen, I did a scenario analysis for you guys, part 2 on euro USD. Right click on that icon right there. Just quickly right click on that icon right now, open a new tab, or if you're watching on your phone, write it down and watch that video after this. The reason for that is I've already broken down euro USD. And it's torn through 2 big demands, and I'm looking to sell that thing a little bit more. And from a macro perspective, what I picked up, while I was away, is we've got global recessions going to affect countries differently. But euro compared to United States, which affects financial markets, whether in Africa or not, this thing matters to you now. It matters to you, all right? It's going to affect South Africa, Kenya, Botswana, Namibia, Zambia, Swaziland, Lesotho. It's going to affect all of us. But euro is definitely guaranteed a deeper, right? A deeper recession, right? Compared to the States for now, right? This is all dependent on, data by data and how quick the FOMC will move as compared to the Euro Central Bank. But euro is going to face a deeper recession. And with that deeper recession, you can imagine there are going to be interesting catastrophic things. An obvious one is the continued strength to the dollar, right? The dollar has been skyrocketing since last year. Strong dollar, strong dollar, strong dollar, strong dollar, strong dollar. We're talking about buy the dollar, hold the dollar, buy the dollar, hold the dollar, buy the dip, hold the dollar, sell euro USD, sell euro USD, pound USD, sell, blah, blah, blah. This has been my anthem. That's how I've made most of my money for the last 6 months-ish. It's been one clean trade idea, all right? And you get in, you get out, whatever the case is. But if there's a deeper recession in the euro, which I believe there will be, you can imagine more money is going to start to flood in, right? Generally speaking, the exchange rate of USD/euro, generally speaking, for those of you who travel or you keep track of all these things, has always been $1.40, $1.30, etc. Just last week, it was 1:1. Right. So 1:1 meaning $1 equals €1. Like the dollar is actually starting to completely out dominate the euro. In fact, this morning, I think it was 1:0, something, 98, something weird like that. Right. This is very weird new territory. So look out for that. This is a long-term thesis. Euro is going to weaken, especially if this recession gets deeper and deeper for them. Right. And there's gas problems. There's the war problems. There's a whole lot of things going on that we can talk about the next time we have time to kind of deal with these things, right? So we've got these perspectives going, but the main thing that I want to keep in mind is not Leroy, but market specialists, market analysts, the gurus of the markets, not Leroy, are telling us that inflation has peaked. That's number one. And because of that, folks, this is technically good news, right? This is good news if you think about it, because if it's peaked, and they are right? That means then, Feds, the stuff that the Fed is doing is working, then inflation will start to come down, and then there's going to be price regulation. There are many good things that we can talk about. But for me, specifically me, if you're to ask me what do I think it's too early. I think once again, you're going to get lured into a trap where you believe that the markets have finally found a new, fresh, holistic bottom, and it's bottoms up. Remember, if inflation is defeated, tech stocks will start to rally, crypto will start to rally, and everything is back to the moon. And that's not my perspective right now. But it's important I tell you a different perspective because I could be wrong. Most of your experts in the markets believe inflation has peaked. And because of that, they believe that the CPI numbers, while high, are a good thing because it's finally arrived at the peak. We finally hit the roof and there's no more room up. Right, it's time to come back down. Right, so that's what they believe. And this could have interesting implications. The only way to prove who is right or wrong in the long run is to wait 2 to 4 months. We're going to see, like I say, we're in July right now. August, September are crucial. The CPI numbers in those 2 months, not just August, but also September, are absolutely crucial. So I'm going to be part of that group, trading safely for now. As I watch this happen, as I watch, more data start to flow in, because the next 2 to 4 months are crucial. If this is a peak, then we will start to see disinflation, right? We'll start to see a pull-off in inflation. It's called disinflation, and we'll start to see some rallies and some interesting recoveries. Now, let me show you what this could potentially look like on a chart like the NASDAQ, right? The popular NASDAQ 100, right? So I've got the NASDAQ 100 in front of me here. I am sharing screen number 3 with you. If you can't see the screen, just let me know. But according to me, this is perfectly fine, right? So what I've done is I've just taken NASDAQ from a different broker, Paperstone, and I've gone to the weekly time frame. And if CPI has peaked, inflation has peaked, Powell is right, they're going to save the day, everything is there. Then some people might call this a bottom, right? A big bottom, a recovery bottom. And if you go to the governing time frame, this is very much in line with that demand that I told you guys at the very beginning of the year, that this is where NASDAQ was going first, right? I was very clear about that. This is the first bus stop, right? There's still, for me, a potential chance for it to go lower, all right? But this was always the case, that we were always going to come here. Why? Because it was the very beginning of an upward channel that got crashed and broken and blah, 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 right? So markets have finally found a good sitting place there. And you can see the month of June is very strong, very green, despite high inflation numbers, right? So that's the paradox, like Leroy, but you got the highest inflation number ever this year, which is 9.1%, and yet stocks are rallying. Why? I saw someone ask that question on the public Telegram group, but I was away, and I was, I appreciated the question and the irony. Like, stocks are up, this is up, what's going on? This is why, because markets psychologically believe that the big problem is over. Because remember, if your thesis is inflation has peaked, then you believe that what's coming now is disinflation, and everything needs to go up to the moon, and we allow the Fed to do what it's doing. All right, so that's where we are with the NASDAQ. Now back to my weekly time frame, because I really want you to see this. You can see that markets have been consistently touching this, downward little line that I've just made up. It's got no technical bearing. It's just a line, right? Traders, do not get married to every single trading strategy you come across on YouTube or free PDFs or every single guru you follow. Don't get married, right? Getting married is a long-term commitment to one thing, all right? This is just a line I've drawn to illustrate something. It's not buy every time, markets touch. There's not even a trend line that I'm referring to, right? But I just want you to know that markets have made a conscious effort to follow this so-called down movement since about the 24th of January this year. Now, if you look at my line carefully, the two lines that I have here, where I've got the base of this downward channel, and I've got a very, very narrow cutting edge. I'm just trying to box stuff in on a weekly time frame, right? One would then argue that this is a breakout, okay? That's the argument here, that okay, fine, this is a breakout. Now we could draw another line, right? We could draw another line, a line that we could draw on Kini-Hashi candles. And that line would kind of like try its best to touch the very first two lines up there and do this. So now we've got, right, the base here where markets have been dropping. We've got this very tight, narrowing in of price. I'm going to give this a red line so that you can see it, right? And then we've got this outside white line. And the argument is, well, if we can get outside here, then we're running for our lives. Now, let's add some levels that make sense to us. Draw a Fibonacci. My Fibonacci is going to be right from the bottom of this, wick here, all the way to the top of this wick of this entire channel. I just want to break this whole section down just to make sense of it. Right. So we could be in A, peak inflation has happened, things are going to rally, we're going back to the moon. B, we're just in a bull, rally, bear market, right? Well, when a bull in a bear trip essentially, where price is going to offer us, some type of critical bounce back, right? So this is the 50% mark, right? You could get a retracement to that level before price drops. you could come all the way up here, right? These nice, dangerous highs, right? TCP highs. And I drew the fib the wrong way. I apologize. I drew a bullish Fibonacci bottom up instead of a bearish Fibonacci, because that's what we're trying to assess. So I'm going to draw my Fibonacci from the top to the bottom, same thing, right? So there we go. We got a 50%, and we could get a very nice big retracement all the way to the 78% levels. This to me is something to look out for, right? And these levels are quite telling for NASDAQ. We're going to go to my original NASDAQ chart shortly, but you can see here, you're really looking at, you know, activity, not even activity, right? A bona fide weekly supply around these areas, right? So from about 14,500 all the way to 15,200, somewhere in here, right? The breaking of this supply is what we should look out for in the near future to come, right? Those of you who are going to be buying up here, buy sober, buy very aware, and buy knowing that I'm not really that excited about those moves. I'm going to play with my currencies until I have clean sales, or until I am sure I hear what the Fed's going to say on Wednesday. Then sure, maybe we can start to buy up there. But there is potential to move to the upside. Now, one thing I want to quickly show you and warn you about is this has happened before in the markets. This is not new. Markets doing this is not new. How do I know this? Simple. Take a Fibonacci once again and take this high here where it peaked last year towards the end of the year, December, all the way to this bounce here, the very first bounce. Remember, markets move in legs, phases, swing high, swing low, right? So now we want to see historically, has NASDAQ done this silly trick before and disappointed people, right? I'm drawing my Fibonacci from top to bottom, right? So all I'm doing is I'm matching this peak up there, right? And this bottom right there. And you can see last time this happened, markets then, we found a bottom. Remember, this was the first bottom we called on the 14th of March. Those of you who follow the channel, right? And markets rallied all the way to that 50% golden retracement area, only to give birth to a nice, beautiful downtrend, which was what I was hoping for back then, right? And that's exactly, you know, a potential setup. You might have markets running to those 50, 78 areas, only to continue again to the downside, right? So just be aware is what I'm trying to say. Be aware. Okay, so this is kind of like the, for a summary. I think for a summary, it's really the kind of themes that have happened while I've been away and not recording videos. We'll quickly pop up to Forex Factory this week. Where is this week? Right. So this week we've got a couple of things, but really, markets like to consolidate. 24 to 48 hours before FOMC happens, markets are very notorious for slowing down, creating ranges so that there's like breakouts and fakeouts, etc. So look out for that. But when Monday opens, you can see, US consumer confidence is a big deal, but Powell is probably going to cover that on Wednesday anyways, right? And then you've got AUD, CPI quarter-to-quarter data. I won't be focused on that, right? So Wednesday, I was wrong. Sorry, the time is 2 p.m., 8 p.m., 8 p.m. Earlier on I said the times have changed. They've not. So this Wednesday at 8 p.m. South African time on this same channel, I'll live stream, the FOMC press conference, and I'll give you guys some breakdown. Now look at this. The forecast, according to the expert, is 2.50%, and that's interesting because right now we know that the actual number that we got last time was about 1.75%, right? So this to me means markets are weighing in a 75 basis point rate hike. All right, markets right now are weighing in a 75% basis point rate hike. I just want to double check my math here, just make sure I'm not crazy, but I don't think I'm crazy, right? So it's 1.75 plus 0.75. Yeah, so you see, so this is the neutral. So we're going with Laura Bossett's neutral, but markets are saying we don't think we're going to get 100 basis point. That would be too crazy, but maybe 75 basis point is fine, right? And I've shown you guys many times that before these meetings happen, come to this tool, Fed monitoring rate tool. And kind of like just see for yourself. Right, so speculation, forex traction across all sites is looking at a 75 basis point rate hike in the next 3 days. But let's see the breakdown. So that's actually, this group here. So 80%, right, of market speculators believe the rate won't go beyond, 2.50, which is really just that, either 50 basis point or 75 basis point maximum. Then we've got about 20% of market speculators who think actually, well, we could even get, 2.75, which would be 100%, basis point rate cut. But for now, it looks like markets have decided to come together and speculate a 75% base rate hike, and that's what we're going to be reacting to, on Wednesday, right? So come this Wednesday, 8 p.m. South African time, I'm going to hit the live. As soon as the rate is out, I'll do a couple of breakdowns, what to expect. Then we're going to break down what the FOMC himself, Powell, the chair himself is saying at about 8:30 p.m. this Wednesday, right? And then after that, there's not much that's going to happen. Advanced GDP, but it'll be very much overshadowed by what FOMC said, right? So let's now get into some chart work, ladies and gentlemen. Those of you who've been waiting for signals, your time is now, right? So maybe let me just start off by actually letting you guys know exactly what I want to look into, so that you kind of like have a very clear path. Because I haven't done a war room in a long time, it's very important I reset my charts, or at least kind of like have a blanket overview across a lot of assets. I don't expect to be in any big swings this week, only because of the market volatility that's going to be happening, during Wednesday, maybe after Wednesday, all right? I don't mind taking my intraday scenario analysis trade by trade, and that's what I'm going to be trading a lot on Monday, Tuesday, and maybe a little bit into Wednesday morning, London session, right? But holistically speaking, when all the dust settles, this is what I want to look at today. Where is the next big money? So the first thing we're going to look at is the dollar, the DXY chart. It's very important we keep track of dollar strength, but also dollar strength in the midst of very big supplies, right? And there's a lot of that going on right now. There's going to be pound USD, USD Swiss franc. Let me just make notes here. Euro scenario analysis video. I'm just making notes to make sure I do not forget to share the scenario analysis video in this video. Please watch that video, part 2 and part 1, right? Right, so we're going to look at USD Swiss franc, then we're going to look at AUD USD, then we're going to look at Swiss franc JPY, we're going to look at pound JPY, finally conquered that trade, but now we'd love to get back into it. So we need to see if there are any openings, USD JPY, AUD NZD. After that, we're going to have a look at CAD Swiss franc, and then we're going to look at pound AUD. Then we're going to look at USD CAD, and we're going to look at AUD CAD, and then we'll look at CAD JPY, and then pound CAD, and then AUD Swiss franc, and we're almost there, folks. Pound NZD, and then finally, if there's time, AUD JPY. So that's going to be 17 assets, give or take 16 signals. Unless if you've got a good broker like I've traded, you can also trade the DXY with me, which I highly encourage. And then on Wednesday, like I said, we're going to have the FOMC meeting that I'm going to stream. Then after Wednesday, I can then do a separate short-term indices, video, so that we can remap out indices. Indices are very sensitive, very quick to move on what Powell's going to say. So it'd be first nice to see, if Powell's going to give us a 75%, rate hike, so we can expect normal movement, or we're going to get a rug pull of sorts, right? So we'll do the indices after, Powell's, gives us, some type of direction, all right? So this is how we're going to move for the next hour or so, and then we're going to call it an evening, right? So immediately off the top, let's quickly look at the dollar. It's been a very long time since I looked at this beautiful chart with you, but my eye has been glued on the dollar, during my break. I've thoroughly enjoyed watching this chart. Everything, there's our big green line, continuous building of upward momentum, different supplies. And I've got this sneaky feeling that every time there's an FOMC meeting, DXY is always in touch with the supply. It feels like this was happened throughout this whole year. I haven't gone back to check the charts, but I feel like in March, and whenever the next Fed meeting was, and in June and in July, all the time there was always, price was leaving a supply on the daily time frame, at least during the actual meeting. Right, so on the weekly time frame of the dollar, you can see that our next big area of interest is at this range of 102.760, and maybe slightly a little bit higher. Why is that the case? Well, because fundamentally markets left a lot of money there just outside of supply, and it would be a good place to trace to, collect more buy orders, and go back up. This is fundamentally based on simple supply and demand trading, right? So that's what we're doing here, supply and demand trading. And that's my rationale, right? So there's a big weekly demand there that needs to be respected. But in the same breath, markets are sitting inside a very big, very healthy supply, governing supply, so to speak. So I'm just going to switch to normal candlesticks. Right, so we can see what's going on here. Right, so these are normal candlesticks now. I'm not using a Kinihashi. I apologize for all the notes in the chart. Let's quickly look left together. Right, so you can see here we've got a supply that is a beautiful imbalance. Markets thoroughly leaving an area of value, massive distribution, wake up, blah, blah, blah. It's on the governing time frame, etc., etc. And you can see here, once again, when Joe Biden took over as a Democrat, as in the month of November and then January, when he actually takes power, this demand holds and markets have been rallying like crazy ever since, taking out this supply, which technically I should remove, but I like to see it. And markets have really shot as deep as they can into this supply, right? So imagine if we were to get technical, right, and just get a simple wick fill. What's a wick fill? A wick fill is when a body of a candlestick the following month, so the whole month of August, we get a strong body here to fill the wick, right? This would essentially completely weaken the supply, in fact, and most likely even break it if we're not careful, right? So this to me is a sign that absolutely the dollar is in a supply, sure, but the sellers are being taken to town, all right? Because if you really think about it, this is a fresh touch, and we know that most of our fresh touches in the market are generally supposed to be, gentle. They never go this deep into an area of value. That's for the retest, depending on the type of supply. And if you want to know about the different types of supplies and demands, which you must know to become consistently profitable, then take the 365 traders course. The link is down below. It's priced down. We're going to keep it at that price, but it's absolutely imperative you spend more time learning than losing money in the markets, right? So this is it, right? So when I bring up these rules, areas of value, how many touches, which specific supply or demand has a different type of area of value, right? This is the kind of stuff that you find as I break it down for you inside our course, video by video, lecture after lecture, perfect for beginners, and people have been trading for 5 years but have seen zero profit, right? Stop doing the same thing the same way and expecting different results, right? That's the definition of insanity, right? So we've got this interesting movement here, right? So markets, really peered through on the monthly time frame, and that sequence continues on the weekly, right? On the weekly, we had this beautiful bearish engulfing pattern, right? Which for me was the end of this week, right? So the red candle that you're looking at is how markets closed this past Friday, the 22nd of July. And to me, that is a bearish engulfing pattern inside the governing supply, and you can see I've got a white line there, and that's because there was a break of market structure on the daily time frame, and I was like, okay, mamma mia, right? This is serious, right? Dollar is taking a break, as it should, right? It's literally within a supply. Now, there isn't a lot of time right now to kind of like do signals and COT data readers. I really wish there was. But when it comes to the DXY, if you look at the COT, if your COT spreadsheet, and if you're a student of 365, your COT spreadsheet is up to date, you will notice when it comes to the longs, they've been slowing down their longs for the last, give or take, 2 COT readings. I'm specifically looking at the 12th of July and the week before that, slowing down longs, closing longs, taking profits off those longs, and they've been increasing their shorts, right? So the CP, the CFT data actually confirms that this is actually a very good supply, and this particular supply is doing its job, and its job is to kind of like lead pressure down. So So how do you do that? First of all, you stop pumping longs, right? So you stop buying in big orders, and you also take profits. You take profits from all these long time, buying that you've been doing. Profits from trades taken on the 30th of May that institutions have been holding, which we all know they're absolutely masters at positional trading, right? This is an interesting supply within the governing time frame, within the weekly time frame, on the daily time frame, right? This is literally a very good confluency run type of supply. This is the chart you wanna stick, keep your eyes glued to this coming week. All right, with this break of market structure, a type of trade I would be absolutely excited for was if markets were to quickly rally here before dumping down again, and then I could get a 1:4, 1:3 type of trade into this demanding area there, or at least break even and hope that markets actually rally all the way down to this lower demand that I've marked out here. But long story short, in the short term, dollar is falling, right? In the short term is hours to days, we expect dollar to fall. In the midterm, we expect that this fall will come to an end, and in the mid to long term, we expect maybe potentially another bull run. Based on many things that I've told you, the euro is in trouble, right? Flights to safe haven, inflation fears are not fully over, right? So we will never know when we're going to need a strong dollar, but this is something to look forward to. As the dollar falls, I hope by now you've got some basic market correlations in place inside your mind, inside your trading journals. As the dollar falls, we expect risky assets to rally. We expect Euro USD to be pushing up, Pound USD to be pushing up, etc., etc. And I'm hoping today we can look at those charts so that we can actually confirm if we're seeing any of those signs. But once again, if you watch my scenario analysis part 2 video, right, on Euro USD, you actually see that I actually alluded to the same thing last week Thursday, that we might be seeing Euro, push its way up, if possible. So please do watch that video and understand why markets are moving that way. Right, so now that I've got some type of clarity on the dollar and I know what's the climate, we then start to look at the broader, currencies. And the first one that we have on our list here is Pound USD. Right, and I really don't want us to cheat, or rather to develop a lazy, sentiment where we forget about big picture. So let's actually consult the governor, even though we believe we know what's going on. So I'm quickly check my notes here. War room 72, high risk trade, H4 entry, also high risk, no confluence. All right, fantastic. So there's a high risk entry somewhere in here. We're gonna see how that worked out. Right, but this is Pound USD. Okay, and you can see Pound USD is doing exactly what Euro USD did. The difference is Euro USD had a very clear demand somewhere here. That price broke through, right? And in here we had a weekly, demand. Actually, a 3 weekly demands here, but unfortunately, markets have broken through, and markets are now simply trying to fill this wick. Once again, if markets break through on Pound USD here, there is no bottom. Markets would essentially have to create a new one. And we know, if you've done the course, that in module 1, the first thing that we do in week 1 of training together is we have to learn how to profile assets. So this is in line with the profile of Pound USD. Because it's in line with the profile of the asset, we can then align ourselves to taking trades in that particular direction. All right, so the governing time frame doesn't tell us much, except for the fact that we're inside a demand, but the demand is weak and price insists on dropping low. Now, it's very tricky to start buying inside a demand, as it is equally tricky, to start selling inside a demand, right? Because the demand wants to push price up, but really what we have here is a sense that, selling pressure will continue. Now, while the dollar is weak, you can see on the weekly time frame, Pound USD has one big green candle. And this is something that you want to look out for. You want to look out for these movements in the next week or two, right? Well, markets kind of like stop here and then fall, because that would be, something to kind of like look up to. All right, there's a nice supply variation golfing pattern sitting right at the top of that governing, demand. Or will markets surpass this area and get up here? Right? Will markets literally surpass this first supply and move their way all the way into there, right? And then on the daily time frame, just to really see what we are working with, you can see that I definitely am more excited about markets coming all the way up here, and that's just during my trading style. I delay as much trading as possible for high probability setups, but it doesn't mean you can't catch yourself a little fish somewhere in here. For me, I will be watching this zone. I'll be watching how markets reject that zone. I'll be watching how markets react to that zone. And if the reaction is that markets are going to turn there, then I'm going to be looking forward to also taking a high risk trade. And this high risk trade will be selling somewhere here to the downside, right? That's what we should be expecting. But until then, as the dollar keeps falling, expect pound to rally. Pound is going to rally to a specific supply destination, either this one, and that might hold, or the one just above. And when that happens, then expect everything to fall, for pound USD to fall in the sense. Right. Next chart. Dollar Swiss franc. Okay, dollar Swiss franc. Just gonna remove the pip counter just so we can see. Once again, I apologize. There's not enough time today to do CCFT data, the COT reports, etc. But in the last 2 to 3 weeks, I've got it here on my notes. Those of you who are in the academy and your spreadsheets are up to date, you go check for yourselves as well. Longs cooled off, shorts interesting play, right? So longs have slightly cooled off on US dollar Swiss franc, right, or on the COT data, and that makes sense because we've just said we can see that the dollar is due for some pull off as well. The dollar did arrive at a supply. That supply pushed price down. The dollar also experienced profit taking from a lot of longs. So everything makes sense of why price would be wanting to fall right now, right? And dollar Swiss franc actually made contact with the supply of their own. So essentially, this actually makes a lot of sense, right? So markets made contact last week, and now we've got this situation here. I'm gonna leave these notes in until we understand what they're for. But on the weekly time frame, you can see that markets have been really gyrating with levels, right? Messing about with these levels here. Bearish engulfing pattern. Markets react to the bearish engulfing pattern. Sold off for 2 months. Markets break this area here and eventually land on a lower daily demand, it seems, because again, there is no confluence here on the weekly time frame. Okay, there's none. So this high risk area where price eventually lands inside this demand, we're going to figure out which demand this is. Is it a daily demand? I would assume so. And then markets kind of like rotated up, and here we are, markets are coming down. Right, I wouldn't be too surprised if markets eventually clear this area. This area is quite dangerous to buy from again. That's my humble opinion. You don't have confluence on the weekly time frame. We seem to have a lot of weakness coming into the markets, right? That markets need to price in, and so anything can go here, right? Especially since, according to the COT report, short positions is what markets are starting to build into, right? So they're definitely not long on dollar Swiss franc right now. Right, and we've got confirmation here on the daily time frame. So this is what it looks like on the daily time frame. On the daily time frame, we've got these solid highs. There's a very big high. There's a shorter, almost made it, but lower high, and then markets all the way down, and then you get a very, very clear lower high right here. Very, very clear lower high. So this is the beginning makings of some type of downtrend, right? And here you are on the daily time frame. You've got almost here, and then you've got a definite trigger into this zone that push price all the way up, but market stopped. And now you've got this pattern being formed on the daily time frame on the far right, where markets could actually interested in using these levels to sell. So please be mindful of this. Please be mindful of this. Right? The supply out of supply is never ever a good thing. It makes it difficult to trade and is such an unnecessary feeling. Like that. Right, so 3 supplies stacked on stacked. You know the rules, higher the supply, the better the odds, right? High probability setups only. Right, but I would honestly be looking to sell something in this particular market. I would be looking to sell, right, fib down all the way to the exchange. Just give me 2 seconds. Right, so I'm looking for a supply that can talk to my fib levels, and there is one right there, and it's just above, another supply. So this might not work out. Right, and then what's just above is just a few. Oh, there's one other big supply there that's holding, right? So this is going to be a trader's choice. Either you enter somewhere here with your stop loss to remain outside, or you wait and you see the momentum, then you wait for confirmation, then you enter as markets drop all over again on USD Swiss franc. Right, so that's USD Swiss franc. AUD USD next.